Now, the PBOC implemented silver export controls, and they're in effect in mainland China. And while these same four LPMCL clearing members are able to access offshore CNH future silver from the western-facing Shanghai Gold Exchange international hubs, the bullion is also being competitively bid to fulfill other global shortages, further tightening supply. Everyone wants silver. So while these inadequate LPMCL US and China shipments may have brought some temporary default relief, the net solution to avoid default is for these silver cartel members to buy back large, unallocated silver exposure with physical at higher market prices. While we expect 53 to be the next rally staging post, liquidity providers assess $140 silver would provide the most likely staging point to bring sufficient bullion to market.
Something's snapping in the heart of London's precious metals trade. Legendary analyst Andrew Maguire says the city has effectively lost control of the global silver market. The system that's quietly kept the market balanced for decades is breaking apart. Traders who once lent silver freely are now refusing to do so because the risk of default is too high. Lease fees have exploded, a clear sign that trust in the market has evaporated. Maguire explains that while US COMEX inventories still look healthy on paper, that stability is an illusion. Most of those warehouse receipts are tied up in layers of paper hedges, meaning the physical metal they represent can't easily be moved or delivered. In reality, London, the world's main hub for physical settlement, is running dangerously short on supply. To keep the system afloat, LBMA clearing members are rushing to shift whatever silver they can from COMEX warehouses to London vaults. But those transfers only buy time, they don't solve the core issue. Meanwhile, China's tightening grip on silver exports has deepened the shortage. Limited amounts from offshore Shanghai exchanges are being snapped up by aggressive buyers across the world. Maguire says this tug-of-war for physical metal signals a market under extreme stress. The price hasn't yet reflected the true scarcity, but when it does, the repricing could be violent. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
London has lost control of the global silver market. We said it last time. It is now so clear it's hard to ignore. Unprecedentedly high risk, unfulfilled local London lease fees illustrate both a lack of trust to lend metal into global supply tightness. So, why you can't trust it? It's too risky. These spreads could be closed at any time. And while registered COMEX inventories appear to be in adequate supply, that is enough to cover a rush of delivery demands, really, as it looks at face value. These leveraged CME warehouse receipts are inequitably hedged against an unfactored lack of local London supply. This is why US lower priced US denominated bullion is slow to be shipped out to capitalize on up to a massively, as I say, attractive $15,000 profit per contract. Silver actually should have immediately been flown out last week, last Thursday, last Friday. 160 SI lots would equal 25 tons. You could put those in on a plane for a matter of a few extra cents per ounce. Yet it was very slow to move. And this is really what we're drawing attention to. And while we're evidencing some profiting from shipping US bars to London, and we'll look at why this will not lower the higher spot price to meet the lower futures price. In fact, the opposite is going to happen. So minor short-term volatility aside, it's the record high global spot prices in every single other foreign exchange currency, no matter which one you look at, across the board. Spot silver is at record highs, unlike protected or capped US-centric futures silver. It's so obvious. It's mind-boggling and yet we listen to Main Street here. I'm on Bloomberg all the time. While they are caught onto gold, they have no idea that the silver market's broken and how undervalued dollar silver is. And that reflects what it is doing is reflecting really the supply shortages, with this effect forcing the US silver prices much, much, much higher. The US is the sole outlier and is being targeted. And while the LBMA clearing members are facing default and are really racing to fly out what little silver bullion they can from the COMEX registered and eligible stocks into London, this is largely serving to satisfy immediate, unallocated, over-the-counter bets that have been called for delivery into empty local London vaults. It's just really keeping pace, trying to keep pace with an immediate default. Notably, illustrating it takes higher prices to bring silver to market. So it's evident this basis EFP spread and lease costs, they expand significantly into lower prices. They contract into higher prices, but literally expand significantly into lower prices. Nobody wants to lease this out. And while inbound US silver shipments are serving to relieve some of the EFP basis spreads between the COMEX futures and spot, currently still averaging a deeply backwardated, I'm looking at it right now, deeply averaging a dollar spread. I mean, that's still $5,000. And we've seen it's about plenty of time to have shipped out silver to meet this demand. It's not hard to put 25 tons on a cargo flight. So global physical shortages is really what they're going to do is really quickly absorb anything that arrives in London. In fact, while shipments are serving to avoid an immediate default, the only solution actually is to bring more bullion to market. It would have to be at higher prices because otherwise it's not going to be offered. Now, the PBOC implemented silver export controls, and they're in effect in mainland China. And while these same four LPMCL clearing members are able to access offshore CNH future silver from the western-facing Shanghai Gold Exchange international hubs, the bullion is also being competitively bid to fulfill other global shortages, further tightening supply. Everyone wants silver. So while these inadequate LPMCL US and China shipments may have brought some temporary default relief, the net solution to avoid default is for these silver cartel members to buy back large, unallocated silver exposure with physical at higher market prices.
Andrew Maguire says the current strain in the silver market is unlike anything seen before, not even during the Hunt brothers' short squeeze of 1979 to 1980. Back then the turmoil was limited to COMEX and could be contained through forced cash settlements. This time the pressure is global. The driving force isn't speculation but real physical demand led by Asian markets. The Shanghai Gold Exchange International has become a dominant player, setting silver and gold prices across multiple currencies and reducing London's traditional control. Maguire explains that most speculators on COMEX are being pushed to settle in cash, while sovereign buyers and central banks insist on taking physical delivery. That's forcing LBMA members to buy back their huge, unbacked short positions at higher prices, creating a feedback loop of tightening supply. He adds that every major bullion bank now holds long positions in silver, a clear reversal from years of coordinated shorting. Prices are rising in nearly every major currency except the US dollar. According to Maguire, the unbacked silver liabilities sitting quietly on the Federal Reserve's balance sheet are being exposed by a global market that's finally pricing real metal, not paper promises. The era of artificial silver suppression may be ending. Let's get back to the interview.
Even into the 1979 to 1980 Hunt brothers short squeeze, these sort of backwardations did not exist. And whereas the Hunt brothers backwardations were able to be contained and cash settled inside the siloed COMEX, where essentially that's where the market was, now the price-setting physical liquidity has been captured by the Western-facing SGEI physical exchanges, influencing every other silver and gold foreign exchange cross. And as we previously ascertained, the quarterly OCC reports, the Office of the Comptroller reports, lists the historically accrued, unallocated, unbacked foreign exchange silver derivative bets being stick-handled for the Fed by the two remaining Fed agent banks, JP Morgan and Citi. Now, do you remember we showed the third quarter unwind of the 5-year derivative bets? That was an important point to note. But actually, out of the 4 LPMCL members, that's ICBC, Standard Bank, JP Morgan, UBS, and obviously, so basically, it's only JP Morgan that provides the only LPMCL cartel member that provides the conduit into the OCC derivative bets. So, ICBC, Standard Banks, UBS, and JP Morgan. Now, notably, and by absolutely no coincidence, last week's rushed together proposed OCC rule, there was a rule change. It slipped under the radar. I haven't seen anyone else looking at this. And what it was doing, it was attempting, this was in a legal announcement, which seemed to be missed by all the mainstream media. It was attempting to rein in bank supervision of exactly these kind of derivative risks. And I just made a copy of it. Quote, federal banking regulators unveiled a pair of proposed curbs on their supervision programs that would formally ban the use of reputation risk. What about people that have been fined close to $1 billion for manipulating silver? Forget reputation risk. As an exam factor, so they remove that, and constrain what examiners can call out for criticism as, quote, unsafe or unsound practices. Going to curb it. Why? There's a panic on. The rule would also encompass unallocated FX gold and silver captured in these quarterly OCC reports. However, given there is simply not enough bullion to meet upcoming delivery demands at current prices, it telegraphs a very, very large move higher. As I say, liquidity providers are assessing $140 an ounce for silver just to meet that demand. Forget anything else. And this is why there's been very few offers to lend silver into higher lease rates. Now, while remaining COMEX speculators have largely been cash settled, and you can see they're progressively, we looked at in the charts, progressively they've been rinsed out. Very large predatory central bank sovereign buyers will force backdoor COMEX loadouts, meaning they'll stand there for delivery, forcing LPMCL actors in related COMEX to buy back these asymmetrically imbalanced bets at substantially higher market prices, further tightening global supply, driving the global price, as I say, much, much higher. So in summary, with every single pulling bank long silver for their own books, every single FX currency bar the dollar higher, these unbacked FX silver liabilities undoubtedly sit on the Fed's books. There's just no doubt. And hence the defense of these very large, asymmetrically imbalanced, naked short COMEX hedges that have been left exposed by physical silver and gold being benchmarked against a real global supply-demand price outside the control of the LBMA CME cartel's ring fence. It is this physical market liquidity that is forcing a real supply-demand settlement price to emerge, and it's only just starting to emerge. These official silver futures short stops have sat at the prior silver all-time 2011 highs. We looked at that. And we've seen multiple attempts to defend these short bets with very little speculator open interest able to be rinsed out, which is currently being attempted every day.
What's unfolding in the silver market feels less like a rally and more like a reckoning. The quiet machinery that kept prices contained for decades is seizing up, and what's emerging is a battle between paper claims and real metal. When clearinghouses scramble, when bullion banks flip from short to long, and when physical delivery becomes more valuable than digital contracts, it's not business as usual, it's a shift in power. Silver is no longer just a commodity, it's turning into a gauge of trust, a test of who actually owns what in a financial system built on promises. The squeeze isn't speculative, it's structural. Once the market fully reprices tangible silver against layers of leverage and derivatives, the adjustment won't be gradual. It'll be the kind of reset that redefines what value means in global trade and monetary policy. If silver's unraveling is exposing the gap between paper wealth and real assets, how far are we from a moment when confidence in the broader financial system faces the same test? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support and I hope you enjoy the video.